Welcome to the latest episode of the Financial Frontier. I'm your host, Patrick Camuso. Thanks for joining today. There is a ton that I want to get into on the regulatory front, on the tax enforcement side of things, as well as some new developments that I'm seeing in my practice at Camuso CPA. So, like I said, there's a lot I want to get into today. Thank you to everyone that's joining me here. Let's get right into it. I'll start to share my screen and we will go over some of the topics that I have prepared today. Give me 1 second here. Okay, window. Okay. So first to get started, I encourage everyone to go to our website at camusocpa.com. Under the resources section, you can sign up for our Digital Asset Digest, which is our newsletter that goes out on a weekly basis that gives you regulatory updates, tax updates, and specific insights. Very similar to these lives and to these podcasts, but I go into much more detail and I hit on a lot of the topics that a lot of times I have queued up to cover in the financial frontier, but time just doesn't allow it. So head over to this website and sign up for this. You won't regret it. There's a ton of value in each one of these. Next month, in January 12th at 9 a.m., I'll be hosting a webinar called How to Avoid Digital Asset Tax and Accounting Mistakes. So this is really geared towards digital asset investors or CPAs, CFOs, and advisors that are helping to manage the accounting and tax functions for their clients' portfolios. I'm going to go over a lot of the issues that I've seen over all my years at Camuso CPA. A lot, some issues that I've really been seeing a lot this past year, I'm going to really focus on. So, and some best practices to avoid some of these issues. So there's going to be a lot of great information in this, so I encourage you to check this out. And if you missed it, on just a few days ago, on December 18th, Camuso CPA and CryptoWorth teamed up to deliver a webinar where we covered a ton of valuable information. This webinar was focused on understanding the IRS on crypto taxes for Web3 companies. So I had a really good discussion with the CryptoWorth team on some of the best practices from both an accounting and tax standpoint for Web3 businesses, some of the tax pitfalls that I see. So again, if you're a Web3 CEO, CFO, CPA, this webinar will deliver a ton of value to you. There's a ton of insightful topics that we included in here. So those are a couple of things that I think it's valuable for you to check out. But now let's really get into the heart of the discussion today. So this just really started happening last night. First, I started seeing reports about this on Twitter and LinkedIn. Then I started, getting some emails and some client correspondence related to this. So basically, it looks like Circle has sent out an email to their users stating that information related to their transactions is going to get provided to the IRS under another John Doe audit. So, if you've been watching the Financial Frontier or following my content on LinkedIn or Twitter, you know that the John Doe audit is one of the IRS's strongest tools in terms of, the first steps are positioning themselves for tax enforcement. And, what this does is it allows them to go to an exchange like Circle, or like we've seen them do just a few months back with Kraken, and say, give me all of your data for each user on your platform that meets certain criteria. Usually there's a transaction threshold involved. So Circle sent out this email basically saying that, the IRS sent them one of these summons, and that if you had 20K in value of transactions in any 1 year between 2016 and 2020, there's a court order that's authorizing Circle to provide this information. So You're probably going to be hearing a lot about this. This is just another step that the IRS is taking in information gathering. This is really the first step. They're gathering information from Circle along with other exchanges, and they're building a fact pattern on taxpayers who are underreporting by getting their transactions, doing their own calculations using, software partnerships and contractors that the IRS is using, and trying to see where people are underreporting or not reporting at all. So this is just another step towards increased tax enforcement with the IRS. I believe this is going to be a very, very big theme moving into 2024 and beyond, as we start to see continued ramp up in tax enforcement cases related to cryptocurrency and digital assets. And as you see, this is going to be a theme here on some of the subsequent topics that we cover as well. So next we have, out of Bloomberg, IRS criminal unit to deploy cyber crime data hub and add body cameras. So in this article, basically it's going over the fact that the IRS is set in the spring of 2024 to open up a new IRS criminal investigation division and a data facility that's going to specifically focus combating cryptocurrency and cyber crimes. These are really two of the big main focuses of the IRS. So the hub is going to be called the Advanced Collaboration and Data Center. The acronym for that will be ACDC. And the stated goal of it is to support the IRS as it targets these cyber crimes. And this is going to be located in Northern Virginia. So this is another step and another investment that the IRS is making to increasing its efforts in combating cryptocurrency tax evasion and just ramping up its tax enforcement on the cryptocurrency side. So then we have this recent article out of Cointelegraph. IRS team reports rise in cryptocurrency tax evasions. There's no surprise here, again, if you've been, watching my content. According to the fiscal year 2023, the IRS unit investigated failures to disclose crypto holdings and report capital gains on transactions. So this article will go on to say that there's been a huge increase in these cases. Let's see here. In an annual report released on December 4th, the IRS investigative arm said it had initiated more than 2,676 cases in which it's identified more than 37 billion related to tax and financial crimes in the 2023 year. According to the team, it's observed an increased use in digital assets, resulting in a rise in related tax investigations. So again, everything's moving towards the IRS focusing on digital assets, on cryptocurrency more. So these investigations consist of unreported income resulting from the failure to report capital gains from the sale of cryptocurrency, incomes earned mining, income received in the form of cryptocurrency such as wages, rental, or gambling winnings. So basically, they're, as stated here, they're focused on people that aren't reporting or that are underreporting. So the IRS has seized more than $10 billion in digital assets since 2015. When this is all said and done and we're looking back on the proliferation of cryptocurrency and digital assets and the rise of this new asset class and industry, one of the biggest winners by far is going to be the IRS. So yes, we're seeing here that even in 2023, we've already seen, as indicated by the IRS, a huge ramp up in enforcement on crypto and digital assets. And again, this is just going to continue to progress. So that this is a big theme right now. So this article out of crypto.news, nearly 50% of crypto investigations in 2022 involved tax issues. So you can see, starting, back a few years, moving forward to where we are now, the crypto tax enforcement has slowly been ramping up, while the IRS has also been collecting more data from places like Kraken and Circle and other places. And while they're doing that, they've been making strategic partnerships with under contracting agreements with software companies that can do the calculations for all of these transactions that they're collecting, as well as contractors that can help facilitate this process. So this is positioning for something big in these coming years here. So crypto investigations are no longer focused on money laundering. About half of the crypto probes in 2022 involved tax, the IRS says. So per a Bloomberg report that's referenced here, Jim Lee, the head of the IRS Criminal Investigation Division, said that crypto investigations now cover various offenses, such as failure to report income, the capital gains from mining. This article is going back into this report again, basically saying that taxpayers are underpaying their taxes, and this is a renewed focus with the IRS. So let me see if there's anything else we want to hit on here, but I think those are the big parts of this. So overall, crypto tax enforcement is going to be a huge theme. And we're even seeing the IRS start to really, take center stage and capture some of the headlines related to the FTX debacle. And that's because the IRS is making a large tax claim related to FTX. So the IRS is demanding per FTX $24 billion in unpaid taxes, and what they're claiming is that this is delaying the recovery of funds. So currently the FTX lawyers are asking the IRS to show how it calculated this, and how are they arriving at this $20 billion in unpaid taxes. The IRS first said that they owed $44 billion, but recently they lowered the amount to $24 billion. So these are massive numbers, and this is going to impact the other claims that are ongoing in this bankruptcy case. So they're looking for the IRS to substantiate this now. And, as this article states, this has been a months-long dispute between the IRS and FTX and the FTX bankruptcy estate over how much the bankrupt exchange and its affiliates owe the government in unpaid taxes. So, one of the quotes here is, the only source of recovery for the IRS is by taking recoveries away from the victims. As there is no basis to assert any class tax claim against the debtors, the IRS's reliance on its own processes only serves to delay the distributions to those truly injured. So the IRS believes it's owed this money, and basically, the position from the estate is that not only do they question whether or not they owe it, they just believe that, the IRS is taking funds out of people that have already lost their money. So FTX called the claim absurd and meritless. Both FTX and the accounting firm responded to over 2,300 IRS information requests and provided almost all documents the IRS requested, except some that will be provided in early 2024. So we'll see where this goes. It's really interesting to see, what FTX and the IRS settles up on. It shows that the IRS is focused on crypto underreporting, from the highest levels to the lower levels at the individual level. So this is something we'll continue to watch. So this article here in Bloomberg Tax is very interesting to me because it's written by Charles Rettig, who was the IRS commissioner from 2018 to 2022. So his opinion matters when it comes to tax topics. And he wrote this, which you would refer to as an op-ed, I believe, in Bloomberg about the proposed broker regulations. And he was very critical of the Treasury's proposed broker regulations, saying that the IRS digital assets plan would be a setback for taxpayer services. So the IRS is planning to tax crypto and other digital assets would overwhelm agency staff by collecting a staggering amount of consumer data. And I have to say that I agree with them here. This has been something that, I've been echoing since we've seen the proposed broker regs. And, if you look across the digital asset and Web3 industry and the professionals that operate in it, particularly on the tax and accounting side, generally speaking, I would say that, they're in agreement here as well. Just because the amount of data that's getting collected on taxpayers really just becomes untenable for companies and protocols that are operating in the space, and also for the IRS and taxpayers themselves. Um, it says here it's important for the U.S. tax rules to be updated fairly to capture new innovations, and crypto's no exception. But instead of collecting relevant transaction data, the expansive rules would set a dangerous precedent, collecting consumer data at a scale that, in this article, says it would undermine the IRS's capacity to perform essential functions and cause harmful consequences for taxpayer services. So that's really the whole crux of this issue. If the proposed broker regs are going to treat basically, anyone that's not 100% decentralized, anyone that has a front end website or is able to impact fees, if they're going to apply reporting regulations to them, the level of tax forms that are going to get sent to the IRS is going to be completely unprecedented. It's going to be multiples than have ever been sent in tax years before in total. So it goes on to say, by some estimates, the non-compliance rate for taxpayers is 75%, represented by itself a potential tax gap of billions of dollars. Now, this is a great point. To solve this problem, we need clear and reasonable rules for brokers and consumers. The way these proposed broker regs are written now, it's just going to create whole new tax compliance issues for both the brokers and the consumers that are receiving this reporting. And again, also the IRS that has to process all the reporting. So yeah, it's just going on to say, the volume of data would overwhelm the IRS, and that the IRS wouldn't even be able to absorb all the data in a reasonable time. And it's just going to create a backlog of, tax returns, and the processing time to these returns, as a result, will become completely unreasonable and undermine the mission of the IRS. So, this paragraph in here I thought was funny. He says, imagine if each credit card swipe for a cup of coffee or a copay at a doctor's office was reported to the government. Because under the proposed broker regs, if you go and you transact in crypto, no matter how small of an amount, in a place where the company facilitating the transaction meets the definition of a broker, they're going to be reporting that to the IRS. So, this is exactly the kind of superfluous information that would be captured under the new proposed digital asset rules. And it's a precedent for the invasion of consumers' personal financial privacy. So this would be, as he's stating here, a huge data grab in terms of taxpayer information, but also just your transactional level data of where each micro purchase is going to be made. So, we'll have to see where these proposed rules go. Even the former IRS commissioner from 2018 to 2022 says right here, as it's written, the proposed rules far exceed the mandate and will hurt the efforts to improve other critical IRS operations. So I think this is really interesting, this article, and the fact that he came out with this. It just shows that there needs to be a higher level of reasonableness and consideration around the proposed broker regulations, and we need to find some middle ground between tax compliance and just not burdening the IRS with unnecessary taxpayer data, and also not collecting unnecessary data on taxpayers to maintain their privacy. So this article out of Thomson Reuters is reporting, some great news that we saw just recently here this past week. FASB publishes its first direct accounting standard for reporting on crypto assets. So this is a big step. I've been covering this topic with FASB and the new reporting standards for a while, and all the stages leading up to this. where, I've been covering this here in the financial frontier. You've probably seen articles in Accounting Today where I was quoted on this topic, as well as just posting on LinkedIn, Twitter, blogs. So I've been very focused on this topic. And I think this is another great step for our industry. FASB on December 13th, 2023, issued its first direct accounting and disclosure standard on crypto assets to provide guidance that more accurately reflects the economics of Bitcoin and similar tokens in financial reporting. So, quick reminder, what this is going to allow companies to do on their balance sheet rather than reporting cryptocurrencies that cause less impairment, it's going to allow them to report them at their fair market value. What will this lead to? It's going to lead to a truer representation of the value of the assets that a company is holding on its balance sheet. And it can make, because they're able to adjust for the fair market value and the overall validity associated with the crypto market, this can make it more attractive for companies to hold Bitcoin and other digital assets on their balance sheet, because from a financial reporting standpoint, they're not going to be at a disadvantage if there's a large drop in crypto and then it comes back up. So as we saw this quote here, it's a baby step in the right direction, because you think about this guidance, it covers the majority of market capitalization of cryptocurrencies, which I believe in. That's a good point. So I think this is a good point. Many companies have been building during the crypto winter and they're ready to launch initiatives. And now we have these accounting standard changes that make it much more attractive for them to actually hold digital assets on their balance sheet. So, I think this is a step in the right direction in terms of corporate adoption. As this goes on to state here, there are substantial disclosure requirements that are a part of these accounting changes. So, it's not going to be without its challenges for companies that are holding this on their balance sheet, but overall, it's going to put them in a better position. So let me see here if there's anything else I want to hit on. So here's some of the disclosures. A roll forward of the combined activity in the reporting period for crypto asset holdings, which is key. Even if this wasn't required, this is something you should be doing for your accounting. For any disposition of crypto assets, the difference between the disposal and the cost basis. If any gains were not presented separately, the income statement line item in which they're recognized, and the method for determining the cost basis of crypto assets. These are really all things you should be documenting and disclosing in your financial statements anyway, but now as a result of these accounting standard changes, these will be required. So this is a great development, and this is something that we'll continue to watch. And if you're a company out here that has to comply with these accounting changes, contact me and my team at Camuso CPA, and this is something that we can help you update or establish the correct accounting system for, and then help you also maintain that accounting system accurately and appropriately in a timely manner on an ongoing basis. So then this article out of Finance Magnates, Crypto in Commerce, a study reveals 60 retail titans embracing digital currency. So this article is highlighting the fact that retailers are also starting to have wider adoption of using cryptocurrency as a form of payment when they're selling different products and goods. And if you recall, on the last episode of the Financial Frontier, I was covering a proposal in Florida to actually offer a sales tax holiday for goods that were purchased in cryptocurrency. So we're starting to see at this, at the retail level, there being a renewed focus on cryptocurrency as a form of payment. And what this study reveals, and what we're predicting in the future, is that there's going to be a higher level of retailers that adopt cryptocurrency and start to accept it. And one thing that I've been really harping on as a result of this is the fact that Sales taxes on chain is something that we're going to have to focus on much more, and companies are going to have to get into compliance with, whether you're just accepting cryptocurrencies and you're selling physical goods and services. We're going to have to collect those taxes on chain appropriately and remit them to the state taxing agencies appropriately and have all the reporting associated with that. Also, as you've probably seen me cover across many different forms of content, because this is a heavy focus of mine, is the fact that NFTs themselves in many states are exposed to sales taxes. So as we start to see more retail adoption of just the use of cryptocurrencies, and as we start to see NFTs pick up steam again in the future, and NFTs be used in different forms and also being combined in retail and in online commerce, sales taxes is going to be a huge issue. And currently it's an area where most companies are not focused on compliance at all. So, it's something that if that's something that you and your company need help with, our team at Camuso CPA can assist you with that. And overall, if you're operating in this space or if you're advising in this space, it's something that you want to be aware of, and you want to look at the overall nature of your transactions and your business and try to understand, is there a sales tax exposure here? Am I in compliance with this? Because the tax enforcement is heating up on the federal level related to income taxes and capital gains like we see. But the next shoe to drop, I believe, is also going to be at the state level with sales tax enforcement and other state tax issues that are related to this. So more than 300 major companies were in this study, and the retail and e-commerce sector emerged as the front runner, boasting 60 companies that now accept cryptocurrency. So again, we're just starting to see greater adoption here: retail and e-commerce, food and dining, luxury retail, travel and hospitality, and it goes on. Internet and online services, entertainment and media, gaming and software. So all of these categories, when you start selling on chain, you're going to have to start collecting sales taxes on chain. And there's several nuances to that I've delineated. You go to my YouTube channel, you'll see the videos on that. But this is something that is not going away, and it's going to become a bigger trend in the future. So those were the big topics that I wanted to hit on this week. As you can see, one of the big themes is tax enforcement. It's only going to be heating up going into the future. And while the IRS is collecting this information and starting to focus on tax enforcement and put more resources towards tax enforcement, we're also seeing an acceleration in the regulatory changes, whether those are the accounting standards with FASB, the proposed broker regulations. So, there's a lot of moving pieces that we're going to be staying on top of and keeping you updated on, including things like sales taxes, which is a new emerging issue where I believe I'm one of the only CPAs that's even really focused on this topic at this current time. So we're really trying to stay out in front of these topics and looking at all of these emerging issues. So if there's any specific topic that you want to hear more about, or that you're seeing in your company or in your practice, whether it's a specific protocol and you have a tax question for it, a new regulatory challenge that you see emerging and you have a question on that, or some regulatory changes and you're not sure how they're going to impact your business, your bottom line, or your clients, those are the types of things I'm really trying to focus on here. And I encourage you to drop me a comment, drop me a message, and let me know what questions are on your mind. And I am more than happy to cover them here on the Financial Frontier and really make sure that we're hitting on the topics that matter to you and matter to your business. So I appreciate you taking the time to watch today. Until next time, I'm Patrick Camuso, signing off.